Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's midday, Thursday, May 21st, 2015, and the title of this week's audio blog is GDP Lunacy Confirms 1984 Has Arrived. Well, thank God for Memorial Day, as it will force me to take a break from my Cal Ripken-like blogging streak, which frankly is exhausting me like nothing before in my life. Due to the nature of my business, not to mention my personal nature, personal investments, and genuine care for my followers' cumulative well-being, I work significantly harder when precious metals are under pressure. And since I started at Miles Franklin in October 2011, i.e., a mere month after record dollar price gold prices inspired the cartel to take price suppression to unprecedented levels, spreading the truth has been a non-stop uphill battle. Not that I was any stranger to headwinds, as I became an oil field service analyst in May 1998, just as oil commenced a 60% plunge so severe it nearly destroyed the global energy industry. A year later, in May 1999, just as that crisis was subsiding, I joined Salomon Smith Barney in New York, fulfilling my lifelong dream of working at a major Wall Street firm. Well, it didn't even take a year before the tech bubble burst, which Solomon was right in the middle of course, with Jack Rubin, causing my compensation to dwindle every year thereafter until I finally left 6 years later. I then took 2 years off, which ironically were the most profitable of my career in mining stocks, before joining the junior mining industry in April 2007, where I spent 4 years in various corporate development and investor relations roles. And take a guess what month the TSX venture, i.e. Vancouver Exchange, peaked. You know, the one that serves as a proxy for junior mining shares? Yes, that very same April 2007, falling 50% until I left mining to join Miles Franklin 4.5 years later. And by the way, it's fallen another 50% since. And this with the price of gold rising from $650 to $1,700 an ounce over this period, and silver from $13 an ounce to $33 an ounce. Consequently, you can see why in mid-2011 I turned from the world's most bullish mining share advocate to its most vigilant antagonist. In other words, I'm no stranger to being punished for being right, as frankly it's not possible for me to have been more right about what I foresaw when I went all into the precious metal sector in May 2002, let alone since joining Miles Franklin in October 2011, given how wildly precious metal bullish the news flow has since been. Frankly, if it weren't for a handful of fateful decisions over the years, some due to plain blind luck, like the fact I happened to buy my house in May 2007 and thus sold some mining shares to do it, I wouldn't be here today performing my dream job of working with the most entrepreneurial group in the bullion business, communicating to the world's most intelligent, forward-looking people. Not surprisingly, one of those decisions was to divest not some, but all of my mining shares in mid-2011 in lieu of real physical metal. I had started this precious metal reallocation when the 2008 crisis made what I had been anticipating for 6 years real, and after witnessing the aforementioned carnage from within the mining industry for 4 years, during which I watched countless dozens of companies go bankrupt, I realized that unequivocally the only way to preserve my savings through what I knew was coming was with the only asset class proven to have successfully served this role throughout time. That said, let's go back to the future that is today, of the 1984 society that seems so unrealistic during 1984, but is far closer to fact than fiction today. Today's principal topic, which I'll get to momentarily, epitomizes the insanity today's 100% commandeered financial world has become, and thankfully I focus principally on the financial realm, and thus am not required to comment on the simultaneous accelerating deterioration of the political and social landscape as well. Out with David Letterman and in with the Kardashians. Before I get to last night's 1984-like government decree, let's toil through the horrific global economic landscape. To wit, in yesterday's Just When You Thought the Worst Was Over, I discussed how the broad, worldwide commodity crash that commenced last fall appears to have recommenced in earnest. Not that it ever really ended in the first place. However, given the past 2 months' relentless support from what I've deemed the copper and oil PPTs, which clearly were tasked with supporting the two most high-profile industrial commodities, a false impression of commodity stabilization was fabricated, replete with every manner of technically oriented bottom caller. That said, the majority of global commodities have remained at or near their post-2008 lows, such as several the Miles Franklin blog has been highlighting all along, such as coal, steel, iron ore, and lumber. Not to mention nearly all non-drought affected agricultural commodities, such as corn, wheat, rice, oats, and soybeans, which, as I pointed out last week, are on the cusp of catalyzing a massive farming depression. Don't believe me? Then ask JP Morgan, which warned of such earlier this week. Anyhow, even I was in awe of the 9% base metal collapse in just a 36-hour period earlier this week, which, as I write Thursday morning, hasn't even shown a hint of recouping. Consequently, the CRB index is less than 10% from its March lows, which I might add are the same lows we experienced at the spike bottom in late 2008, when essentially all financial markets went no bid. And this with oil prices having risen 43% since March, demonstrating just how poorly the average commodity has since performed. Yes, my friends, the commodity overcapacity I warned of in January's direst prediction of all, which admittedly was heavily inspired by David Stockman's Great Deformation, is dramatically worse than in 2008, masked only by government goosing of stock, bond, and other favorable markets with unprecedented money printing and market support, both overt and covert. Not to mention the most blatant economic data rigging in history, which is precisely what today's principal topic focuses on. And sadly, such overcapacity, at a time when global demand growth is grounding to a halt, will only worsen as the epic malinvestments catalyzed by 15 years of reckless central bank financial oppression are liquidated. Look no further than China's historic real estate, construction, and infrastructure bubble to see just how much capacity must be eliminated, as more than 15 trillion of bad credit has been created at the behest of its psychotic communist government in China since 2008 alone. In other words, it's no fluke that from all corners of the planet, economic activity is at its lowest level in decades. And as for debt accumulation, simply saying it's unprecedentedly, severely understates just how ugly the situation has become, as essentially all categories of debt, from sovereign to corporate, municipal, and individual, not to mention at the central bank holding level, has become unpayable. And this with global interest rates, on average, at 2,000-year lows, thanks to the maniacal ZERP, NERP, and QE programs that, per the definition of the Ponzi schemes they represent, can never be unwound. This is why a high-up Bank of Japan official just 3 weeks ago claimed unwinding to be impossible, and even the thought of exiting QE a nightmare scenario. Not to mention the tectonic market shifts that were the subject of my May 7th audioblog regarding the mysterious worldwide rate rise in recent weeks despite relentlessly weakening economic activity and dramatically expanding dovish sentiment. Which, by the way, Zero Hedge did quite a good job in demonstrating that it's likely been driven by Chinese selling of U.S. Treasuries, validating what I have surmised for weeks now, which, if it is actually the case, could deal a lethal blow to Western efforts to whitewash economic collapse with stock and bond market support, no matter how much printed money is thrown at the task. Back to the collapsing global economy. Let's start with this morning's news that even the comically goosed Chinese manufacturing PMI came in below 50, as usual below expectations, for the third straight month. I mean, at what point will the world come to the logical conclusion, and by logic I mean simple relationships that most third graders can grasp, that China's economy is not only not expanding by 7% annually, but to the contrary, contracting at a very significant rate. I mean, isn't that the definition of a PMI reading below 50? Which, by the way, is where Chinese PMI readings have sat for several years now. Oh well, I guess we'll just have to apply the handy-dandy bell curve the Chinese government supplies us, and at least admitting that the so-called 7% GDP growth it purports is in fact the slowest growth rate in more than 30 years. That said, Chinese stocks rocketed higher on this news as the messy, essentially unregulated equity bubble the PBOC has created, just like the unprecedented construction bubble the Chinese government fostered, is rapidly surpassing any other in history, including tulips, internet stocks, and even Chipotle, Tesla, and Shake Shack. With each passing day, it becomes painstakingly clear that the Chinese government has not a clue what it's doing, as while it has successfully garnered the world's manufacturing base by doing nothing but allowing the exploitation of its unparalleled pool of cheap labor, it has fostered the ugliest, most globally paralyzing economic and financial bubbles in history. Thankfully, 1,000 years of history with the dangers of fiat currency have fostered a culture within both the population and government of precious metals devotion, which is probably why China's 1,054 tons of official gold reserves are likely 10 or more times higher. Ultimately, when the end game is foisted upon the world by out-of-control financial markets, which no matter how much they are manipulated will ultimately occur, China will reveal just how much it has, which likely will not only save the nation from economic implosion, but for decades to come, firmly ensconce it as the global economic leader. That said, as discussed in May 5th's When Will China Reveal Its Massive Gold Hoard, I find it highly unlikely such a revelation will be made until such calamity arrives, as in doing so it will set off a chain reaction of economic collapse that will make 2008 look like a walk in the park. Frankly, it's unlikely China's current government would survive the shockwaves, and since politicians care only for staying in office, there's little chance, in my view, that the Chinese government would make such a bold move unless its hand was forced. Thus, for those that actually believe the Chinese could care less about the yuan being included in the Western SDR basket, don't raise your hopes too high. Meanwhile, even I'm amazed at how little press coverage has been given to the ECB's statement this week that it aims to, quote, front load the massive 1.2 trillion euro 20-month QE program it just started 2 months ago under the auspices of a dreaded low liquidity environment during the summer, which, as I discussed 2 days ago, is as comical as King.com claiming it too experiences a seasonally weak period for online gaming during the summer, while simultaneously claiming earnings were impacted by foreign exchange fluctuations. In other words, claiming a significant amount of sales are generated in international markets, half of which experience winter when we experience summer. Anyhow, clearly the ECB believes the monumental 25% plunge in the euro it has catalyzed over the past year is not enough, as euro GDP is dead in the water, whilst unemployment has barely budged and debt has exploded. But don't cry for the 1% that own bubble-like European stocks and worthless sovereign bonds, who have made out like bandits, whilst the 99% have suffered. Meanwhile, Greece will likely go bankrupt by June 5th without a new massive bailout. You know, exactly what Alexis Tsipras' Syriza party vowed not to take. Doing the math, this is just 2 weeks away, but thanks to said market manipulation, apparently the pending default of up to 400 billion euros of Greek debt is not a cause for alarm. Not to mention similar separatist movements in essentially every major Eurozone nation, from Italy to Spain to France. And now even in England, as the UK wants to have its Brexit from the Eurozone entirely. Not to mention the anti-austerity tidbit of the day, of left-wing Portuguese politicians threatening a political revolution unless Troika-instituted austerity measures, which have been just as destructive as in Greece, aren't immediately repealed. Here in the States, the Atlanta Fed's nowcast, which had the first quarter's anemic 0.2% first quarter GDP growth rate, which by the way will likely be dramatically downwardly revised in the coming months, it had it pegged for months in advance. And yet, until the very end, the Wall Street consensus was still expecting 2 to 3% growth. Not 0.2 to 0.3%, but 2 to 3%. Which is why it's so amazing that as recently as last week, the Wall Street consensus for 2Q GDP growth was 2.5% compared to the Atlanta Fed's aforementioned nowcast of 0.7%. Not to worry though, as they finally ratcheted their consensus estimates down to 1.5% this week, still twice as much as the Atlanta Fed, en route to points much, much lower, which was validated in spades by this morning's 7 for 7 misses of everything from jobless claims to the Chicago Fed National Activity Index, the Bloomberg Consumer Comfort Index, PMI Manufacturing Index, Philly Fed Survey, Kansas City Manufacturing Index, and what's this? Existing home sales, which, not surprisingly, completely validated last week's weak homebuilding sentiment reading and equally vehemently invalidated Monday's bogus housing start number, which, even if it were true, was still weaker than the worst housing start reading at the trough of each of the past 5 recessions. Further nailing the point home, here are some of today's Zero Hedge headlines in response to the aforementioned weak economic data barrage. Philly Fed hovers near 15-month lows. Prices paid collapse most since Lehman. Economic hope crashes by most since 2013 government shutdown. Chicago Fed contracts for 4th month in a row as initial jobless claims hover near 40-year lows. U.S. manufacturing PMI tumbles to lowest in 16 months as new orders tumble. Kansas City Fed in recession territory. Which brings me to yesterday's 2:00 p.m. Eastern Standard Time publication of the supposed minutes of the FOMC's April 29th meeting. Longtime readers know that I not only believe such minutes are doctored, but could not be more certain. Basically, the Fed's team of 120 plus taxpayer-subsidized, printing press finance lackeys reword such statements to emphasize points they believe the markets will more readily accept, given the economic and financial market conditions at the time of minutes publication, i.e. yesterday. In other words, the publication of a bunch of meaningless notes, which were consolidated into an official policy statement a month ago and followed up by who knows how many speeches by the various Fed presidents, has become a de facto mini FOMC meeting, which, when coupled with appropriate market manipulation, like smashing gold, goosing stocks and bonds, and having a John Hilsenrath article ready to print in the Wall Street Journal within minutes of the minute's release, are used to influence perception of what the Fed is likely to do. Heck, even Rick Santelli, who can't decide if he's a CNBC propagandist or a Miles Franklin blog-like truth teller, claimed the minutes matter, despite anyone with half a brain knowing they decidedly don't. In this case, economic data since April 29th, or the April 29th FOMC meeting, has been beyond miserable, let alone as the oil and copper PPT rallies simultaneously fizzled out. Interest rates and the dollar surged, and the ECB initiated the aforementioned QE expansion. Consequently, I wrote yesterday that, quote, if any remaining cheerleaders, propagandists, or pardon my French, idiots, still believe the Fed may raise rates at its June 17th meeting, they will likely be forever silenced this afternoon. And shortly afterwards, the September rate hike believers, and thereafter, anyone who still believes a rate hike will ever occur. Not that I've heard a heck of a lot of June rate hike propaganda since last month's horrific GDP print. However, it doesn't take much, like an aberrationally better than expected housing starts number amidst a veritable ocean of economic weakness, to get the rate hike propaganda going. Which, by the way, in a free market environment would be like putting a gun to the head of the stock and bond markets. But not today, where Wall Street and MSM propagandists try to convince us that rate hikes, contrary to centuries of empirical data, are violently positive for stocks and bonds and violently negative for gold and silver. Then again, according to these government-partnered financial sociopaths, rate declines are equally violently positive for stocks and bonds and equally violently negative for gold and silver. In other words, they'll have you believe, no matter what is going on in the world, from economic utopia to nuclear war, that stocks and bonds can never go down and gold and silver can never go up. Well, in the Fed's infinite wisdom, they realized discretion was in this case the better part of valor. And thus, instead of making up some mumbo-jumbo about recovery and optimism, they simply mirrored what it said last month, causing MSM lackeys like Yahoo Finance and Reuters to post as their top stories headlines like, Fed sees June rate hike as unlikely, minutes indicate. Well, duh, followed of course, by the prerequisite precious metal raids, both immediately afterwards and this morning, and conversely, as Zero Hedge put it, blatantly illegal algorithm spoofing to push the Dow Jones propaganda average higher. Oh well, another Fed can kicking, another day closer to economic Armageddon and the inevitable Yellen reversal, and at today's historically depressed precious metal prices, a day closer to supply shortage, mining bankruptcy, and peak gold and silver. Okay, now that this week's housekeeping is complete, let's move on to yesterday's hideous Atlas Shrugged moment, which even in my world was so shocking, I had to pinch myself to realize I wasn't an unwitting participant in a real-life Twilight Zone episode. Actually, the fact that yesterday's article, titled If the Children Are Our Future, Run, dovetailed so perfectly, only made it that much more surreal, especially as the investment Pied Piper itself, CNBC, was smack dab in the middle of both such nightmares. In the first, I showed a clip of CNBC's head propagandist, Steve Leisman, interviewing the teenage winners of the 2015 National Economics Challenge, both of whom claimed John Maynard Keynes to be their favorite economist, in one case because he, quote, spends a lot of money. In other words, economic brainwashing has successfully spread to the one group of people with any hope of breaking free, essentially sealing the fate of all but the minuscule percentage of truth seekers willing to not only accept the truth, but act to protect themselves from it, no matter how unpopular such actions might be. That said, yesterday's pronouncement from the Ministry of Economic Truth, the Federal Reserve's hall have become, is far more terrifying, validating everything I wrote in last year's All Economic Data Are Lies, and putting said truth seekers on notice that the aforementioned Chinese economic data bell curve is about to be applied here, and likely in Japan, Europe, and anywhere else. Central banks are desperate to prove that printing money, and consequently destroying citizens' cumulative standard of living, is justified by economic results. In this case, the topic is the so-called seasonal adjustments the government has used since the economy peaked at the turn of the century, which, despite the fact that by definition such adjustments should be a zero-sum game throughout the year, turn out to be invariably positive, such as the BLS's birth-death model, which, despite record low business formation statistics and record high business terminations, insists year upon year that hundreds of thousands of mythical jobs are created. In the seasonal adjustment category, we're now being told that the Fed is concerned that such adjustments are flawed, in that they are not large enough to depict the true strength of the economy. You know, like the adjustments the BEA, or Bureau of Economic Analysis, made last year to GDP calculations, like the inclusion of non-productive research and development, intangibles like goodwill, and non-tax-paying illegal businesses like prostitution and drug dealing, in order to raise the overall GDP level and thus lower the widely watched debt-to-GDP ratio. That is, when excluding off-balance sheet debt like nationalized entities such as Fannie Mae and Freddie Mac, let alone hundreds of trillions of unfunded liabilities, which are somehow not considered debt. Anyhow, in a statement delivered via Steve Leisman of CNBC, who clearly has been appointed the television equivalent of the Wall Street Journal's John Hilsenrath, the San Francisco Fed made this unbelievably ridiculous Fed-speak promulgated assertion, which even makes me blanch when I read it. Quote, the official estimate of real GDP for the first 3 months of 2015 was shockingly weak. However, such estimates in the past appear to have understated first quarter growth fairly consistently, even though they are adjusted to try to account for seasonal patterns. Applying a second round of seasonal adjustments corrects this residual seasonality. After this correction, aggregate output grew much faster in the first quarter than reported. For years, I have asserted that measuring GDP is no easier than finding a needle in a haystack, and that frankly, it's impossible to accurately perform, even without the utilization of accounting chicanery. And particularly when the BEA plays God by deciding how much to adjust data, much of which, by the way, is not empirical, but statistically generated, which, given its role as a government agency, is as inherently positively biased as Wall Street firms are of the stocks of their investment banking clients. That said, in publicly speaking of this, as they put it, shocking flaw, they are not only admitting GDP calculations to be flawed, but they are decidedly positively biased. In other words, shouting to the world that U.S. government data, as in China, is now completely under the control of propagandists hell-bent on publishing whatever needs to be published to convince the world all's well, and consequently that the Fed's ZERP and QE to infinity schemes are working. To which we simply ask you to view the world around you, not from the Fed's rose-colored glasses, but your own eyes. In which case, if you are one of the few aforementioned truth seekers, motivated not by hope, but reality, you should have no problem seeing right through it. And again, when it comes to physical markets like gold and silver, it matters not how hard the paper algorithms attack, as when all is said and done, they can't manufacture metal that doesn't exist, or an economic recovery, or a tapered central bank balance sheet, higher employment and real wages, or a fiat currency regime that is not destined to fail. For that matter, if you are considering the purchase or storage of precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. To that end, we invite you to listen to the two special podcasts I recently taped with our president and co-founder, Andy Scheckman, both of which are available, like everything else the Miles Franklin blog produces, for free on our website, or better yet, by simply Googling the title. The first, taped last fall, is titled Brink's Montreal Storage Program, and the second, taped last month, is titled Swaps, Trades, and Repatriations, discussing myriad opportunities to optimize your precious metals portfolio. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks, and have a great Memorial Day weekend.